News Talk 94.5 WPTI, 96.7 FM WTOB. You're listening to the Wealth Guardian Show with Doug Ray, helping you to retire the job and keep the paycheck. I'm your host, Doug Ray, and with me is Mr. Brice Payne. This morning, Brice, we're going to be talking about 5 lies you might be telling yourself about money.
And we might even do more than 5, Doug. Good morning. How are you? There's no shortage of lies that we tend to tell ourselves about money out there. So, hey, we didn't get to say hi to you over the 4th of July weekend. How'd you guys do?
We did great. The grandkids came down for a visit, so we all stayed up at the condo up in Boone and just had a wonderful time. You know, the children played in the pool. They went gym mining. They went to grandfather. I mean, it was a ton of fun for everybody.
Outstanding. Very nice. Yeah, Belle and I went up to Lake Lures, my first time up there. That's a nice place. Some really nice views on those houses on the lake there.
Mm-hmm.
All right. Well, you know what we're going to be talking about here, lies that you might be telling yourself about money. There's a lot of them out there, so we thought we'd pick a few and just talk about what they mean and why they might not work to your advantage if you keep telling yourself that lie. But before we get started, let's go ahead and do our Wealth Guardian service salute. Every weekend morning here, we want to take just a moment and recognize and acknowledge and say thank you to all the men and women and the families out there who put on the uniform and do what they can to keep America safe and out of harm's way. So here's that moment where we're going to give you the salute. Thank you very much for all you do. You are not forgotten, and we do appreciate you. And Doug, thank you for your service. Garrett, thank you for your service as well in the Navy there.
My honor.
So, Doug, we always ask ourselves at the start of a show here to better get to know your Wealth Guardians advisor. And the question I'm going to ask you, and then you can ask me the same question, and we might as well ask that of you out there as well. Doug, what life lesson did you have to learn the hard way?
Boy, life lesson did I have to learn the hard way? Man.
Putting you on the spot here.
You are.
Yeah.
I guess what comes to mind is in the 6th grade, that was one of the worst years of my life, learning how to speak in front of the public.
Oh, yeah. I had to start standing up and doing reports, huh?
Yeah, and we had to read a poem, Robert Frost, Two Roads to Virginia.
Yeah.
I had it memorized, had it cold, and as soon as I got up and kids, it was gone.
Yeah.
And I got an F.
Oh. Probably the only one you ever got, though. So, but yeah, that can be tough for some people. Some people, it's not as hard. So, ask me, Brice, what life lesson did you have to learn the hard way? I suppose there were 2. One, anything to do about physics, and an object that is in motion tends to stay in motion, and an object at rest tends to stay at rest, and all those types of physics things. I learned those lessons through my dirt bike, and I wiped out on a dirt bike more times than I can ever recall. And those I've got scars on my arms, on my legs, on my head from learning physics lessons the hard way. What a bike can and can't not do, what kind of angles you need to be, how much you have to brake before turning. But in a more serious note, credit card debt. When I got out of college, I fell trapped to one of those credit card booths that sat up on the university grounds, and I got one, and I'll put some money on a credit card once in a while. When I realized that I put $100 on there and that my minimum payment was only $7, I thought, this is the greatest thing ever. And it took me a number of years to get out of credit card debt, and haven't had it since. And I've very much tried to teach Aspen, my daughter, not to ever get into credit card debt. That's one that can hurt you. And, that's one of the lies that we can tell ourselves about money, isn't it? All right, well, let's talk about the first one here. So lies that you might be telling yourself about money. And Doug, we see a lot of these come through here when we're talking to somebody who's trying to decide whether or not they need a financial planner, or if financial planner can help them navigate through retirement better than what they do on their own. The first one is, I'll pay back the money I've taken out of savings or borrowed from my 401k.
Yeah. It's easy to say, right?
Yeah.
It's harder to do. And my personal view of borrowing from a 401k is only if it's an absolute emergency.
Yeah.
Yeah, you pay it back. The interest is paid back to yourself, but still, sometimes it's very difficult to pay back those 401k loans. So I'm really against it.
Yeah, it's we've seen a couple of clients who have gotten in a pinch and need to do that. But Doug, we have seen more than one or two or even three clients who want to try to do that 60-day rollover from their IRA. They're going to take money out of it. They're going to borrow it just for a short time, and then they'll put it back in. If they can put it back in within 60 days, it's not a taxable event.
Yeah.
And literally more often than not, over 50% of the time from my experience, it does not work out that way. They are not able to get the amount of money back in within that 60 days.
Especially if they're using it to buy a house, hoping they'll sell their old house.
They'll float the money.
We've seen that so many times in our career.
Yeah.
It just doesn't work.
Yeah, that's exactly right. Hey, if you're just tuning in, you're listening to the Wealth Guardian Show with Doug Ray. I'm Brice Payne in the studio this weekend morning with Doug Ray, recovering after our weekend off for the 4th of July week. And we're talking about the favorite list of lies that we have seen, Doug and I have seen people coming through and telling themselves about money that probably doesn't work to their advantage, keep continuing to lie to themselves about this. So we just talked about, I'll pay back the money I've taken out of savings. The next one we want to talk about is, we hear this from time to time, why bother with investing? It's rigged against the little guy.
Well, I'll have to tell you about the market. There are some peculiarities from time to time, but I don't think it's rigged against the little guy. I mean, if you invest and you invest routinely, like in a 401k, you're going to, over time, make decent returns.
Right.
So don't think that the market is rigged against you, because, yes, sometimes it has some weird happenings, but it's not rigged against the little guy.
Can I say this? I would change the word little guy to naive. The market is rigged against the naive. Yes, there are ways that you can make money in the market. There are ways that you can lose money in the market, and there's no shortage of people who are out there ready to make money off those who don't know what they're doing. But, I mean, not that we are fans by any means of mutual funds here at the Wealth Guardians, but mutual funds over a long period of time are going to, in most cases, do better for you than just having put your money in the bank and getting CD rates. So it doesn't take a lot of experience or skill, but the naive are those who invest at the wrong time and move into cash in the wrong time. It's very easy to do that. And so I would say the market might be rigged against the naive, but it's not rigged against the little guy. Whether you have a lot of money or a little money to put in the market, if you invest it right, and there's no magic formula to that, it's some common sense and read a book on the market and how to invest, and that's probably going to suffice you in at least doing better than what you would have done in CDs and guaranteed rates, and
For sure.
the FDIC does. Speaking of the way to properly allocate your portfolio, Doug, you and I are financial planners, and a lot of times people will conflate a financial planner with an investment advisor. Mm-hmm. Now, investment advising is one thing that a financial planner does, but it is by no means the only thing that a financial planner does. As holistic financial planners that are fiduciaries, we here at the Wealth Guardians are going to help our clients navigate pension options, Social Security filing options, distribution strategies, tax mitigation strategies, estate planning. We help our clients with all of that, which is kind of beyond the scope of what a typical investment advisor might do. And we usually go through a 4-meeting process with somebody who wants to come in and sit down with us. But here's the magic part, Doug. You know this. There is no cost or obligation to sit down with us.
Exactly.
It does take a few meetings, but your only obligation is your time and your gas to get to our offices, which are in Clemens, North Carolina, here in the Triad area. And we will sit down and see if our services and our expertise and our skill sets align with what you need in planning for retirement. We are fiduciaries, and any recommendations that we make on your portfolio or your tax mitigation strategies are obligated to be in your best interest. If you'd like to sit down with a no-cost, no-obligation retirement planning session with us, here's our number, 336-391-3409. That's 336-391-3409. You can also reach out to us at our website, thewealthguardians.com. And again, we would look forward to sitting down with you and seeing what help we can provide for you. All right, let's get back to this list of lies that we're telling ourselves out there. The third one here for the first segment is, the bank is the safest place to keep my money right now.
Well, clearly, you're covered up to $250,000 of FDIC coverage, but you shouldn't have all your money in the bank. Like you shouldn't have all your money in your company stock. You need to be well diversified, have a total portfolio the bank is a great place to put emergency funds. Right now you can get nice, rates on CDs, 5% even.
Right.
Quarter, I think.
Yeah.
So, yeah, but not all your money. Don't put, the old saying, don't put all your eggs in one basket.
Yeah.
Applies to banks.
I've heard that, yeah. And the bank is the safest place to keep my money right now. Doug, there's about 12 different types of risk that you can take out there with your money. We're all familiar with market risk. We're all familiar with stock risk, meaning if you had all of your money in one company, you're not taking market risk, but you're taking risk on that company. But there is inflation risk as well. That's another type of risk that's out there, and there's not as many people think about that one. And if you have all of your money or even a significant portion of your money in the bank, yes, it's safe from market risk, it's safe from losses, but it's not safe from inflation. So there's different things you have to protect yourself from out there. We're going to come back here in the second segment and continue our conversation about lies you might be telling yourself about money. But before we go to break, what are we doing? We're asking Doug a trivia question. Doug, you were in the Navy. You've been on some ships?
Yes.
You've been on some planes?
Yes.
You ever experienced some kind of adverse weather conditions out there when you were
many times.
on the ships? All right, here's our question. On July 9th, 1958, a mega tsunami hit Lituya Bay, Alaska, producing the largest wave ever recorded. Now, I'm not going to have you be specific here, but you know what is a large wave and what is not a large wave. How tall was this wave?
Well, I've actually seen waves that came up to the flight deck of a Nimitz, so that's 90 feet.
All right. Well, you think about it over the break, and nobody out there look it up, and we will be back on the other side of this break. Stick around. This is Brice Payne. With me is Doug Ray. The show is The Wealth Guardians, and this is News Talk 94.5 WPTI. And this is 96.7 FM WTOB. News Talk 94.5 WPTI. 96.7 FM WTOB. Welcome back to the Wealth Guardian Show, where we help you retire the job and keep the paycheck. I'm Brice Payne in the Wealth Guardian studio, along with Doug Ray this weekend morning. Thank you for joining us. In this second segment here of the show, we're going to continue our conversation about lies that you might be telling yourself about money. But before we answer that trivia question that we left you hanging with at the end of the segment, I want to ask you this. Are you planning to retire in the next, say, 10 years? Okay. Have you met with a retirement income certified professional who's also a fiduciary yet? If you haven't, I want to invite you to take us up on a complimentary review of your current situation. So as certified retirement planning specialists, we're going to put together a customized written plan with strategies for 1, portfolio allocation, 2, income distribution, 3, Social Security filing, and 4, tax efficiency, with the additional benefit of often reducing both the risk and fees of your current plan. So if you've put aside at least $400,000 and you want to take us up on this no-cost, no-obligation review, I want you to give us a call at 336-391-3409. That number again is 336-391-3409, or visit us at thewealthguardians.com. That's thewealthguardians.com to learn more. Let us show you how in black and white we can help you retire the job and keep the paycheck. All right, let's go ahead and get back to this trivia question. Doug, as being a man being in the Navy and who's been on some ships, I'm sure you've seen some large waves. And so here is the question. On July 9th, 1958, a mega tsunami, which I looked up the definition of that, that's just a very large tsunami, hit I think I'm pronouncing this right. I hope I am. Lituya Bay, Alaska, producing the largest wave ever recorded. Now, I'm not going to have you be specific here, Doug, or exact, but how tall do you think this wave was?
Pure guess. I'm going to say 200 feet.
I should have said, and I knew you were going to do this, I should have said, I can almost guarantee you that you're going to underestimate how this was.
How about 200 feet?
Doug, a lot more than 200 feet.
Really?
1,000.
No way.
720 feet was the largest wave ever recorded. Yeah.
Oh, wow.
Now, that might not have been how big it was when it actually hit the shore. You know, the waves are out. They measure the waves out there in the ocean as well. But that's large. I mean, that's a lot of, that's 5 football fields.
Yeah.
Well, gosh, don't want to try to surf that one. I know.
A third of a mile high.
Yeah. Garrett surfs. He surfed the North Carolina coast. I think probably the biggest wave to ever hit there was maybe 30 feet. All right, let's go ahead and get back to our show here. Lies you might be telling yourself about money. Doug, let's get to the, let's see, we've got a lot to choose from here. You pick one. You pick the next one that we do here.
Well, let's just do this. I rely on Social Security.
Okay, very good. Okay. I'll rely on Social Security. Doug, Social Security, almost everyone in the United States gets to benefit from Social Security. Most of them contributed to it, so you get something to take out of it. But Social Security is designed to replace what amount of your living expenses?
Maybe about a third.
Yeah, somewhere around 40%.
Yeah. So, you can't just rely on Social Security. Yes, granted, it is a leg on the stool of retirement planning, but you need at least two other legs.
Yeah, that's right. Now, not to say that it's not going to be there. We get a lot of people who are afraid it's not going to be there. I don't think that that's really a concern for somebody who's approaching retirement now, but it is not in most cases going to be sufficient to be your only source of income. So you need to put away some savings in most cases. So saying you'll rely on Social Security and therefore you don't need to save for retirement, that is going to come around and bite you big time.
100%.
Absolutely. So if you're just tuning in this second segment, we're continuing our conversation here on the Wealth Guardians radio show, lies you might be telling yourself about money. There's a lot of them out there. We have a planning process that we go through with our clients where they come in and sit down. We go over all the details of their income, their assets, their expenses, and we help them figure out whether or not they can retire now or how much they can spend in retirement or how much they can leave the kids, whatever their goals and objectives might be. And we find there's some patterns in what types of lies people tell themselves. And so we're just kind of going through that list. I'll take up the next one here, Doug. I'm too young to start retiring, to start saving for retirement.
Oh, please. Come on. That is a cop-out. That's what that is.
Yeah, I agree. I don't think anybody really believes that. I mean, if they are, they're not numbers people.
That's for sure.
Einstein said compound interest is the eighth great wonder of the world. And he actually has a couple other comments about compound interest. If you start putting money aside now and investing it to where it's growing at a reasonable rate, somebody who started doing that in their mid-20s compared to somebody who doesn't start that until their mid-30s, right, the amount of money that the person's starting to put away in the mid-30s because they've missed out on 10 years, not just of contributions, but of compounding interest, the amount of money that they have to put aside to eventually catch back up to where they would have been if they started at 25 is astronomical. And that's why you can look at those numbers and say that can't be right. That absolutely cannot be right. Yeah, but it is. Amazing. It is. So that's...
And Brice, to follow up that question, here's another lie.
Okay.
Investing is only for people who understand the stock market.
Okay. Talk to us.
Oh, gosh. Come on now. All you have to do is just, if you're young, just consistently dollar cost average it to something. It can be as easy as just buying the ETF SPY, which is the S&P 500.
Right.
Just do it over and over and over. Yes, you're going to go up and down with the market, but if you're young, and you don't have to know the ins and outs of the market like Brice and I do.
That's right.
But just do it. You know? And over time, you'll be absolutely amazed at how much money you will have in your account.
I have had more than one person going through the planning process with me who comes into the office and they had a vast majority, if not essentially all of their monies in some kind of safe investment where they're not in the market. And one quote that somebody told me, he didn't mean it to be a quote, but now in my head it is. He said, "I don't play other people's games." Well, my mental response to that is, well, then make the market your game. You don't have to be an expert at it, but at least read a book or two on the different types of investments out there and the trends that are in the marketplace. And it's all of a sudden not somebody else's game. You don't have to know when to move into the market and when to move out of the market. You can just, as Doug said, just dollar cost average periodically, every paycheck, every month, every couple of months, regardless of what the market's doing. And if you're doing that for year in and year out, you will have benefited far more than if you had just put the money in the bank and not play that other person's game.
Absolutely. And I'll say this for our clients, we do have on the equity side of our portfolio stop loss provision. So we do have the ability to make sure that you don't lose half your money in a 2008 type market downturn.
That's exactly right. And so if you're getting ready for retirement and you're starting to wonder, I've felt the full ups and downs of the market before as I'm, in some kind of S&P 500 mutual fund or a couple of mutual funds that are essentially all in the market. And I don't know that I want to go through another 40% decline as I'm approaching retirement or when I'm in retirement. Financial planning is a multifaceted set of criteria, set of aspects that we cover as financial planners. But investment advising is one of those, and we help our clients make sure that they are not taking excessive risk, especially when they are approaching retirement. Look, you can be fully exposed to the market in most cases when you are 20s, 30s, or even 40s. But as that time horizon shortens to when you'll be using your money, you want to make sure that you are not subjecting yourself to another huge market downturn. That is one of the things that as financial planners, we help our clients do. If you'd like us to help you make sure that you're all set up, both portfolio allocation-wise and tax mitigation-wise and distribution strategy-wise, we can help you figure that out. There's no cost or no obligation to sit down with us, but you do have to reach out to us and set an appointment. So here's the phone number to do that, 336-391-3409, 336-391-3409. We would look forward to sitting down with you and seeing if we can help you get your retirement plans properly aligned when it comes to working with money.
Let me add this, Brice.
Please.
We all know the Fed's been raising interest rates like crazy. It seems like they're on pause now. Mm-hmm. So we are now the economy is just now seeing the effects of the first interest rate hikes. We're starting to see a deterioration in the economy. 100% of the time when the Fed has gone on an interest rate hiking cycle, this economy has gone into a recession. I don't think this is going to be any different. And in those recessions, we've lost an average of about 32% in the stock market. Mm-hmm. So what I'm saying here, now is the time to be very, very cautious. I think people have been used to this great bull run we've had since October of last year. Bull runs don't last forever, folks.
That's right. In fact, we did have, technically speaking, a little bit of a bear market, but it was one of the smaller bear markets we had a couple of years ago.
The COVID bull?
Yeah, the COVID. But that we have been on the market has been on a really good streak since the financial crisis. Yeah, there's been a few little bumps here, but nothing significant like that. And it's bound to happen at some point. So again, if you're wanting to not expose yourself to that as you're approaching retirement, sitting down with a holistic financial planner who's a fiduciary would probably be the first step that you'd want to do. So let's round this up, Doug, for the last one here. I don't earn enough to hire a financial advisor.
Oh, come on.
Okay.
You know, that I think, again, I can call that a cop-out, too. You know, we don't cost tons and tons and tons of money. In fact, the way we get paid is basically a percentage of the assets under management. So it's not like you're writing a check to us every quarter. It's just coming off your returns.
Yeah.
So anybody can hire a financial advisor.
I have long likened the financial planner, if I'm going to use a metaphor for that or a simile, would be a fitness instructor. Mm-hmm. And would you ever say, I'm not healthy enough to go to the gym? Well, it's probably the ones that need to go to the gym the most, isn't it? So, all right. Well, you know what? I think let's run one more real fast one here. I'm single, so my retirement plan will be really simple.
No, that's a lie.
Right. That doesn't make any sense. So whether or not you're single or you are married or have been married a number of times, that has nothing to do with how easy your retirement is going to be. The types of assets that you have, what kinds of accounts your monies are in, the different types of income that you're going to have in retirement, that can happen to a married person or a single person.
Absolutely.
So that has nothing to do. If you think, well, I'm just going to have my Social Security and one other source of income, I don't need a financial planner because it's going to be easy. Well, try laying down a tax strategy mitigation plan for yourself and seeing if you've done that right.
That's exactly.
So that's an easy one to end on there. No, please do not think that just because you're simple that your retirement plan will be simple as well. It can be complicated based on the income and the assets and the type of assets that you have. What isn't simple, I hope, is the rest of your weekend. I hope you get out there and find a lot of things to do around the house or out in the town. We live in a great area here. There's a lot of fun things to do. But that's going to wrap it up for me and Doug this weekend. We thank you for joining us. We hope we'll see you back here again next weekend at this same time, showing you how to retire the job and keep the paycheck. And I want to remind you, sound financial plans do not create themselves. This is News Talk 94.5 WPTI. This is 96.7 FM WTOB.